Although we finished off the lows, we were reminded today that equity markets do not simply rise monotonically. Stocks have idiosyncratic risks associated with that stock specifically, and of course they usually have equity market risk, some more so than others. Today I will be joined by Options Metrics Head of Quantitative Research, Garrett DeSimone, who will discuss these dynamics and use Tesla, one of the most widely traded stocks, as an example. Stick around for open interest. Hi there. Okay, so joining us today, I'm really excited to have Garrett DeSimone. He's the head of quantitative research at Options Metrics. And for those who are unfamiliar, Options Metrics is one of the more highly regarded firms with respect to options data. And this is useful not just for people who trade options, although those are the primary users, of course, in many instances, but it helps investors more generally understand how the stocks are going to behave based on the options data. So Garrett, very pleased to have you with me today. I'm looking forward to what you've got to tell us about.
Thanks for having me back on the show, Mike. Pleasure to be here.
So what we're going to be taking a look at specifically are some of the things that I was just talking about, which is how we think about equity market risk when we start looking at individual stocks. A lot of people who are viewing this probably think about this more commonly as beta. So when you think about people trying to select stocks individually, looking to generate some sort of idiosyncratic returns, we're often thinking about what managers are doing to select securities, generating alpha. But beta, of course, is how we commonly think about how stocks behave more generally. And we often associate beta with each stock. So we often refer to high beta stocks and low beta stocks and so on. So perhaps you could walk us through, I know you have a number of slides and I want to give you ample time to go through them, and you can tell us a little bit about how you look at these things and some of the stuff that you're seeing coming out of the data.
Yeah, absolutely. So to give some background to something we do differently at Option Metrics is we actually look at the option market perception of data. So typically when academics or researchers look at a stock's beta, which is its co-movement with the broader market, they think about historical returns. So they'll take the last year of returns or the last 5 years of returns and try and match the correlation of the stock with the market and get a beta measure or a riskiness. What we do at Option Metrics is we bake in the option market's perception of risk going forward as a factor of implied volatility, as a factor of the stock's implied correlation with other constituents in the broad market index. And then we take the forward-looking market vol. So this implied beta measure actually is a better estimator of what the future systematic risk of a stock will be. And one of the ways we kind of implement the beta and look at it in our research is thinking about the returns of high beta stocks relative to low beta stocks. And in our classic, let's say, risk return world, you would expect high beta stocks to have a higher return on average than low beta stocks due to their elevated risk. But what we end up finding, and that has been documented in kind of defensive equity strategies, is that high beta stocks tend to be overpriced relative to low beta stocks. So their returns aren't necessarily justified by their higher betas relative to the lower, less risky, less exciting kind of securities.
Yeah, so it's interesting. You know, I've heard Jeremy Grantham speak about this periodically. I don't know that he was thinking about it in terms of volatility necessarily. He was just talking about whether or not the equity risk premium and sort of that relationship between expected returns versus risk, that investors will typically demand higher rates of return for accepting higher risk. And we can think about higher risk in terms of equity volatility. We can think about it in terms of, say, credit risk. And I think that was the way he was thinking about it, that he observed, or you know, the guys over at GMO had observed, that you didn't necessarily receive over time superior rates of return for taking, for example, buying equities that had higher degrees of credit risk. So, for example, you could have, high investment grade businesses, AA businesses, or high BBB businesses, And the expectation would be, because they have lower degrees of credit risk than, say, triple B minus, or even maybe more speculative credit grades. But that wasn't actually what the data revealed. That over the long course, you would have, of course, intervals, discrete windows of time when these stocks would swing around, and of course they would outperform. But over the long term, that they didn't necessarily see that. I guess my question would be, how does one extract implied beta from options prices? Do you basically take the index volatility and kind of deduct that in some fashion? How are you sort of getting to this implied beta number?
Yeah, absolutely. At a very high level, what we do is it's sort of synonymous in a way to thinking about a historical beta measure using option implied terms. So we can think about as the market vol, which is a factor in historical beta, we actually use the implied volatility component from the market. So that gives us our market volatility measure. And then when we think about the correlation relationship, which is the correlation between the stock of interest in the market, we actually look at an implied measure. So this tells us what the option market thinks the implied correlation between securities are. In other words, what is the 30-day expected correlation between Apple and Tesla, or Apple and Meta? And then we take the volatility, so let's say it's the single stock volatility of Apple, and we all bake that into our formula. So now what we have is an option market view of what the next 30 days beta should be, as opposed to the classic historical measure, which we've seen from the CAPM, which is like the covariance over the last year of daily data. So this accounts for earnings announcements. This accounts for high risk news events like the Fed announcements, inflation announcements, because we have that forward looking volatility component.
So when you're taking a look at these forward-looking volatilities, are you looking at it in a generalized way? So, for example, are you sort of backing out a single correlation measure from, say, the top 50 constituents of the S&P? So give you an example. So let's just say that a dispersion trader might say, okay, I'm going to look at the relationship between S&P implied volatility as a function of the square root of correlation times the weighted constituent volatilities of the individual stocks. Or maybe they're probably going to just look at the top 50, right? Because nobody really cares that much about the 497th ranked stock in the S&P. That's not really going to have too much of a bearing on either the movement of the S&P or the movement of S&P options. But a name like Tesla or Nvidia or Apple or Microsoft, if you think about the top 25 stocks, are probably pretty representative. So is that kind of what you're doing, taking those largest constituent stocks, taking a look at the weighted respective volatilities of those stocks and comparing it to the volatility of the index and then backing out a single number? Or are you actually doing something where you're kind of looking on a stock-by-stock basis?
Right. So I'm actually really glad you asked that question. So we actually provide the correlations, like you mentioned, from the top 50 pairwise. So that'll be, your Tesla Meta, for example, your Meta Apple pair. And then what we actually calculate the correlations between all 500 securities as part of our implied beta calculation. But we readily provide the top 50. But what that does is it gives us a correlation between, let's say it's our Apple beta we're interested in. We take that correlation, the weighted correlation, because every constituent has a different weight based on the market capitalization or SPY's weighting. We multiply it by its Apple's volatility and then divide it by the market volatility. So that'll give us sort of a measure of what the kind of average weighted correlation is times the single stock vol over the market vol.
So I guess now the interesting thing here, of course, is that these relationships change through time. And I think some of the stuff you have for us is related to that. I know that people viewing are always kind of interested, how do I take what seems, especially if you're not used to looking at these metrics, this seems a little esoteric at first, but actually you have some ways that we can sort of think about it, with individual stocks and what that relationship might actually mean. And I think one of the examples you also have for us is Tesla, since that's one of the most popular stocks to trade, particularly in the option side. I know that everybody watching is going to be particularly interested in that one. And they might also be interested, even just the people who are trading the stock itself, because I happen to be looking at this and I saw that over the last couple of years, the performance of Tesla, I mean, it's ridden quite a roller coaster. Outperformed the S&P considerably for a time, underperformed considerably for a time. Going back, I think now to November of 21-ish or so, I think the stock is pretty much dead even with where it was then. S&P is up 40%, consumer discretionary up just under 20. So tell us a little bit how we can take this data and use it from a trading perspective, whether you're an equity trader or an options trader, and what you might be seeing in some of these things now.
Yeah, absolutely. So one of the ways to think about beta is kind of look at it in a relative sense, right? So we can compare our highest beta securities, their return, to the lowest beta. And when we were discussing defensive strategies earlier and thinking about what the low beta return is compared to the high beta is, one way of thinking about these is typically if you've got a low beta portfolio, it actually outperforms a portfolio consisting of high beta stocks in the long run. In a risk adjusted sense, typically as an institution, or we'll look at this trade as a beta neutral strategy, so they'll just remove all the market risk from it. But one of the ways to think about it is, if you're an independent trader, is just purely the measure of risk you're taking on when you think about implied beta. So this will give you a sense of, if we've got a beta of 3, for example, which Tesla hits in one of these graphs we're gonna see coming up, that means the market expects that the Tesla's moves will be 3x the moves of the broader market. And what's interesting about the implied beta measure is it has a lot more variation throughout time, with earnings announcements, with big economic news, with firm fundamental news regarding its riskiness. So an investor can look at the riskiness of the stock in real time and understands what, if they've got a percentage of their portfolio or they're trying to get to a beta of 1, how much risk buying Tesla stock adds to their portfolio risk overall.
So the beta, I think you were just hinting, of Tesla has been dropping. So one way to think about this would be that if you were constructing a portfolio and it was a much higher beta before, and the beta itself, or so realized beta, has been dropping, implied beta is dropping, that you could actually allocate a larger percentage of the portfolio if you're trying to do some kind of risk weighting to Tesla now than you could have before. Is that one way to read this?
Yeah, absolutely. If you're trying to keep your portfolio as close to 1 as possible, you can allocate more risk to Tesla. Obviously, Tesla has some other risks associated with it other than pure market risk, but this will give you a indicator of how much risk you're taking on. And what I find particularly interesting about implied beta is we see these spikes in the chart, particularly around mid-June, October. These are earnings spikes, which is indicative of the fact that correlations increase during earnings, because investors are looking at kind of what a bellwether would be for the industry. If Tesla comes out with earnings, how are other EVs going to perform? How's the market going to perform as a whole? So we'd expect the riskiness of the stock to go up in earnings. If you take a historical beta measure, you won't see that kind of variation. So as someone allocating their portfolio or at risk adjusting their weights knows that the risk almost goes from 2 to 3 during this earnings period. So your portfolio has become substantially riskier when viewing it through an implied beta lens.
That's interesting, because I think that intuitively one might have thought the opposite. In other words, that you would think that a stock would track with the market between catalysts where new information about that company specifically would come to the market, which of course is exactly what occurs during earnings. Earnings is when you find out information that maybe some knew, but generally the market did not know, that is unique to that company, or at least to its industry, perhaps. But what your graph shows actually is that beta is rising. So that I think is kind of interesting. I mean, we would think that the risk would rise, but I don't know that we would intuitively think that the beta would, right? If that makes some sense. The other thing that I think is interesting here is that Tesla has recently, for some period of time now, been underperforming the market. And this chart that you're showing us also shows that the beta is coming down. Would one way to interpret this simply be, well, there's been a disconnect between Tesla and the market, but is it also true that a high-flying stock, when it, let's say, comes back to earth, that its beta might normalize at a lower level? Is that one way to think about it? You know how some people look to risk metrics, it doesn't matter whether it's RSI or implied volatility percentile, they look to these things as potential warning signs that maybe there's a lot of froth in a stock. Does a high implied beta, could one also think about that as kind of a risk measure that says, well, maybe you want to be a little bit more cautious with this one?
Yeah, absolutely. And the way to think about it is, in anytime there's a major sell-off or a major risk-off event, high beta stocks are the first to go in the dumps. So it's when you're looking at a portfolio, the highest ranked beta securities, you are taking on a large level of macro risk, and a large level of risk when the market drops that these stocks are very susceptible to. What was particularly interesting about the kind of narrative around Tesla is that this stock has not performed well at all over the last several months, but in terms of its beta measure, its risk has fallen. So this can signal a few different things. One of them being is the correlation from Tesla to other market constituents is falling, which makes sense given the outperformance of a lot of these AI stocks. So Tesla is almost on its own path. The other aspect is Tesla is actually entering a more stable growth phase where it is not becoming, like you mentioned, a high-flying growth stock where we expect these outsized returns year over year. So it may be moving into a more stable kind of revenue region as opposed to being a high-growth stock.
One of the other things I know that you look at is, when you're looking at the options market, is kind of a measure of sentiment is measured by things like skew. Also, whether the distribution is likely to have some funkiness and kurtosis. We don't have to get all wonky into second and third moments right now, but I think you had some interesting stuff for us on the skew side too. So the stock was, as you pointed out, it has underperformed quite significantly over the course of the last several months. And it seems like what you were seeing is that the sentiment, the concern about downside risk was higher, and that now it might be shifting in another direction. Is that fair to say?
Yeah, absolutely. So if we take a look at this chart, this is our implied volatility skew of Tesla measured as the out of the money put vol, which is we take as 25 delta minus the out of the money call vol. And it gives us a sense of how much traders are pricing the expensiveness of downside risk relative to upside risk. So when we see a large positive skew, it would mean out of the money puts are more expensive than out of the money calls. So option market investors and traders are much more concerned with large downside drops, or they're worried, like you mentioned, the distribution about returns being to the left side, left skewed. What we're seeing here with Tesla is we did see some high positive skewness late in the fall, but that's mainly subsided and the distribution has become even with the skew floating around zero. So we can say that from an option market perspective, upside and downside risks in Tesla are nearly balanced. So again, this goes against the narrative of Tesla being beat up so badly, or maybe it's been beat up to the point where now the price is stabilized and the perception of risk is stabilized.
I think this is it's really quite interesting. So, I think when you look at data like this, two things sort of stick out to me, and that is that a combination of the skew and the implied beta measures that you previously showed, that if one used that to essentially mitigate your long side exposure in the name because of that sort of elevated you have two risk metrics, both sort of in the yellow to red, if you will. It's an interesting case because you actually would have avoided significant pain if all you did was trade stock. If you were just a Delta 1 trader, but you use these metrics to downsize your position when the numbers were elevated, and And I don't happen to know whether that dip in the skew happens to correspond because the stock has obviously been volatile. It'll be really interesting to map those two over one another. But just to use it as a trade sizing tool, and also just a sentiment shift. If you're looking for circumstances where everybody's looking down, maybe you wait for these things to sort of turn directions, and then you decide to get into your positions in somewhat greater size. Is that, do you think, one of the utilities that one might consider for these?
Yeah, absolutely, Mike. And I think it's a when thinking about beta and thinking about skew and thinking about upside versus downside, the two combined make a powerful combination because you're thinking about two different aspects of risk. The beta component is the market risk or the systematic risk. So that's one dimension. The other dimension is your very violent moves to the downside that the skew kind of helps you parse out. So if you look at securities that have a very strong negative skew, those are ones you probably want to avoid because they're susceptible to massive downside movements. And then combining that with beta, you have a less volatile security that is also less exposed to large downside movements, which can enhance returns. So the combination of those strategies you can think about in terms of your weightings of your securities, or what kind of depending on your holding period these are two powerful signals I think you can combine to optimize your portfolio.
Well, that's really helpful. Garrett, thank you very much for joining me today. Your insights, as always, are welcome and very helpful. For those of you out there who are interested, go to Options Metrics and find out more about their offerings. They have a lot of very interesting data for institutional users, as well as retail offerings, I'm sure, for those self-directed investors who are inclined to sort of advance what they're doing. In just a moment, we're going to start talking a little bit about a company that's going to be reporting earnings. So stick around. We're going to be talking about MGM very shortly. Okay, so over the course of the weekend, I drafted up a trade idea on MGM, which is going to be reporting earnings. And one of the things that I wanted to discuss was why we use options trades relative to just simply trading equity. And what I have for us first is, why don't we take a look at MGM's earnings over the last 11 years. So this chart depicts the performance of MGM from immediately preceding earnings for 1 month thereafter. So if you had simply purchased the stock, one quick thing for those of you who are used to looking at time series charts, the most recent date is actually over here on the left, and the farthest out in time is over on the right as you're looking at the screen. Now, one quick thing I would point out about this is that the biggest drawdown that you see there, which is a decline of, like 50%. That actually took place when they reported earnings in early 2020. So that specific data point is actually associated much more with the pandemic drawdown in equities generally, and the shutdown of the hospitality industry specifically. So most will remember that when quarantine went into effect, they shut down all of the casinos. And of course, those casino stocks got hit very, very hard. So as we look at earnings going forward, we're actually going to pull that one data point out and take a look at what the performance would be. So if we take a look at the next chart, what we're going to see is what the performance would be if one were to buy the stock just before earnings and hold it for exactly 1 month until thereafter, or as close as you can get, with the trading calendar being what it is. And what you will see here is that the performance over time would have resulted in an aggregate return of almost 40% or so. Now, bear in mind that, of course, we're looking at 11 years worth of data, but the presumed holding period is actually only 1 month. So the total holding period that you're looking at here is actually only 43 months because we extracted the pandemic period. Now, if you impose an options strategy as an alternative, one thing that one could consider is using something like a call spread risk reversal. So in the next chart, that's actually what I came up with here. So this is a trade whereby one buys an upside call spread and finances that in part by selling a downside put. Now you'll notice when I priced this out today, that total cost was going to be about 5 cents a contract, $5, because each contract represents 100 shares. But the objective with a trade like this is essentially to get near upside participation and then give yourself a little bit of a buffer so that if the earnings news is good, you get to capture some meaningful portion of the upside news. If the earnings result is not so good, you will still have a risk of having the stock put to you. You will purchase the stock, but you will purchase it at that lower stock price. So if you get that put maybe 5, 6, 7% out of the money, if the stock drops 10%, you're only going to lose 3, 4, 5% rather than the full 10 holding the trade until expiration. So let's take a look now at how that structure would have performed over the course of the last 11 years. Again, we're excluding that one pandemic period, and compare that to what holding the stock would have looked like over the exact same time frame. And the results intuitively should make some sense to us. So first of all, we're using a call spread for our upside exposure. When you use a call spread, you're buying an at-the-money call, you're selling an out-of-the-money call. That upside call that you're selling creates a cap on the maximum profits that you can achieve. And so if we're looking at the options trade here, which is articulated in orange, you can see that indeed there were many instances when the stock would have outperformed. The other thing that we expect to see, because we're selling a downside put, is that we have some downside exposure, but the downside exposure is always going to be less than buying the stock right here, because you're selling an out-of-the-money put. That stock's going to be put to you at a lower price. So even though you have equity-like risk, your basis will be lower. So we also see that. But you'll notice one final thing. Every now and again, you're going to see a blue line with no orange line. What's happening there? Well, what's happening there is the stock did not rise, it fell, but it fell somewhat modestly so that the stock would have lost some money, but the options position, you never actually took the stock, so you didn't experience any loss at all as of expiration. And what we find is that this strategy did two things. It reduced how much you lost when you lost, and in some cases, you did not lose where the equity did. So about 26% of the time, the call spread risk reversal lost money, and this was the result. So now if we actually advance to the next slide and take a look at the cumulative returns that one would accomplish, notice that this chart compared to the equity is much smoother. So the volatility, both up and down, is reduced. That's exactly as we would expect. Our upside gains are capped because we're using a call spread, not just a call or just having all of the upside that would be associated with the equity. Our downside moves are somewhat more muted. And what's interesting is that the average expected return here is smaller than with the equity, but the cumulative returns of the strategy is actually greater. We get about a 50% cumulative rate of return using this strategy versus just under 40 using the equity and with lower volatility. And the reason I wanted to illustrate this is that in those situations where there are relatively large implied moves for an underlying stock and the options premiums are kind of high, as they are in MGM at the moment, you can get these call spread risk reversals with a decent buffer. So in this case, you're looking at probably a $3 upside call spread that you're looking at on a $45 stock. And again, this is only looking at a month, so 3 over $45 is a decent percentage. Same thing to the downside, 43 strike put. So that's going to be about $2.50 out of the money. So you're giving yourself a decent downside buffer. Wanted to use this as an illustration of how you can use options trades to get better risk-adjusted rates of return over time by manipulating two things. One, how much you lose when you get things wrong. And I think that's arguably the most important thing. But the other is also reducing the probability that you get things wrong. And this trade accomplishes both. You cap how much you can make, but because you reduce the probability of being wrong and because you reduce the amount you lose when you are wrong, the returns over time actually end up being superior. So MGM, gaming stocks, we generally do like the gaming stocks. Most of these names have recovered quite handsomely from those pandemic lows. I was surprised to see Las Vegas Sands, which has mostly exposure to Macau, for example. That was a company that, it basically has gotten right back to where it was pre-pandemic. So if you're looking at some of these names going into earnings, consider using things like call spread reversals. I'm Mike Coe. Thanks for watching Open Interest. If you like this kind of content, please be sure to hit that like button, hit the notification bell so that you can get more videos just like this one.